In today's video I am going to answer a question made by one of our subscribers about an event that took place in the British pound versus the US dollar. The question is about whether or not there was some sort of manipulation in the market along with some dramatic news events that raised the volatility of the currency pair. Since I was not part of this trade, I will have to look at the chart in hindsight to see what could have happened. I decided to transform this question into a video for the channel because there are a few very important lessons to be learned here, and this chart example illustrates that almost perfectly. Let's take a good look at the chart to see if we arrive at some useful conclusions. Here you can see that I marked highs and lows in the major flow and in the minor flow as well. This would be the first problem in this analysis because each trader tends to mark these things out a little different. The major flow is usually more important than the minor flow with the exception of those moments where we try to identify a subtle flow change before anyone else in the market. We must be careful while trying to do that because we can end up seeing flow changes where there are not any. The ultimate consequence of that is that we will be giving more weight to the minor flow, which is a mistake most of the time. This is one of the ways that traders get confused about the market. In this chart we can observe two major flows very clearly. The major upward flow goes from number 1 to number 4, and the major downward flow goes from number 4 to number 11. Notice that between number 3 and number 4 we have several small higher highs and higher lows, but these would be classified in the minor flow according to my interpretation. To see that clearly, all you need to do is to compare the size of these small higher highs and higher lows with the size of the market vectors between 1 and 3. Here we have to make the distinction that the market vector between 3 and 4 is just one movement upward in the major flow even though we can see many minor flows formed. This is the problem of the subjective interpretation of price movements. If you don't have practice with this, you can make the mistake of classifying those minor vectors between 3 and 4 in the same hierarchy as the vector between 1 and 2. It's not only a mistake, but it's a deadly mistake because if you classify these market movements in the wrong hierarchical order, you will end up buying where you should sell and selling where you should be buying. Moving on in our analysis, we can see that after high number 4, the market starts to cascade down forming market vectors that are stronger than the market vectors between 3 and 4, but weaker than the major movements from 1 to 2. This is the key observation to understand what this market did after candle number 11. Notice that we have a hierarchy of buyers and sellers here that happens to be very clear. The buyers that originated the movement between 1 and 2 and also the movement between 3 and 4 appear to be stronger than the sellers that produced those movements between 4 and 5, and all the subsequent vectors down for that matter. All you need to observe in order to see this hierarchy is the volatility of the movements. However, the sellers from number 4 onwards are clearly stronger than the minor buyers that appeared between number 3 and number 4. That's probably the major point of confusion in this chart. Without understanding this specific hierarchy, you would probably be looking to sell the market in number 8 or number 10 or even number 6. The problem with selling in those areas is that the buyers from number 3, which are higher in the hierarchy of power in this market, are too close, and therefore, there would not be enough headroom to produce a good risk-reward ratio. If you understood this hierarchy between buyers and sellers in real time, the candlestick number 11 would pose a textbook perfect fractal flow trade. We have established that buyers from number 3 are stronger than the sellers from number 4 onwards due to the volatility they expressed in the chart. The blue horizontal line is the level where those powerful buyers appeared for the last time, and this level has not been violated yet, which makes low number 3 a perfect place to put a stop-loss order. Notice that we have a simple reversal divergence happening between number 9 and number 11, and of course, the icing on the cake is the candlestick number 11, which happens to be a bullish fractal candle with a relatively large lower tail implying that buyers from number 3 are indeed still here to blast the market up. Candle 12 probably happened to be in an important news announcement that just helped increase the volatility of this market to the direction it was already intended to go. There is no manipulative maneuver in this area around number 11 as far as I can see because this is a textbook perfect trade for a strategy that uses confluence of signals and contextual building. The price came back to the powerful buyers in number 3 and then took off. If you were shorting this market a little before candle 11, you probably skipped over the part of the analysis that deals with the relationship between buyers and sellers. This is the sort of thing that can happen when we only look for setups and ignore the context in which the setups occur. Nonetheless, let's assume that this contextual reading of the market was actually difficult to do in real time. If you watched the last video I posted on the channel about the Parendo's paradox, you could play both sides of the market and walk away from that with a nice profit. This is exactly the kind of situation in which the Parendo's paradox can help you. You could very well be selling in the candle before number 8, which is a fractal candle with a stop above 6, trying to take advantage of the beginning of the downward flow from number 4 onwards. In the light of the last video posted on this channel, the short trade from number 8 would be considered the game 1. The long trade in number 11 would be considered the game 2. The combination of both of these games would generate a winning strategy even if you could not be able to recognize the hierarchy of buyers and sellers in the proper way. Notice that successful trades always have a few prerequisites. The first prerequisite is the understanding of the hierarchy between the players of the market. You not only have to recognize which market player is dominant, but you have to recognize where they appeared, and where they might appear again based on a unique hierarchical structure. The second prerequisite is that you understand where the edges of the market are, so you can trade with good trade location. The third prerequisite is that you have an area in the chart in which you can trust based on undeniable market structures. Another lesson that can be extracted from this example is that we don't really need a Forex news trading strategy. Consider news events as adding fuel to the fire. It increases the flames, but it does not change the structure of the fire. The market does the exact same thing despite strong news or not. The only difference is the volatility. In this example, you could have made money even if you were not aware there was a big news announcement ready to take place. That would be the case because by analyzing the market logic correctly, no manipulation or news announcement will be able to fool you. This is an oversimplification of course, but it fits the anecdotal purposes of this video. I hope this analysis served to clarify what exactly happened in this market. If you want to learn how to trade like this, access our strategy store and purchase the Fractal Flow Strategy video course. If you enjoyed the video, don't forget to hit the like button, subscribe to the channel, and leave your feedback in the comment section below. Thank you for watching.